Buenas tardes. Thank you for having us. My name is David Gibbs. I'm with CME Group in Chicago. Joining me later in our session today will be my colleague Giovanni Vicioso, who is our product expert on all things crypto, and we'll be diving into greater detail on the exciting world of crypto futures. But to sort of set the table, I'm going to provide the program today with an overview of CME Group, a little bit of background about who we are if you're less familiar with us, highlight our leading asset classes and some of the products that are available in there, and a little bit of structure about how we conduct our business. So I'll begin quickly, and then I will be passing the presentation on to Giovanni when I'm finished. To begin with, I need to say that today's session is meant to be educational and informative and is in no way to be construed as offering investment advice, nor am I making any trading recommendations. So who is CME Group and what are we about? Well, it all boils down to a four-letter word in English, riesgo, I believe, in Spanish, but risk in English, and it's only 4 letters long, but it's a big deal. Risk is inherent in every business, in every industry, and in every part of the world. What we've tried to do in our 170 plus years of existence in the futures industry in America is construct solutions to risk management, or in other words, to provide risk management solutions. And those solutions are going to be different depending on the business that you're in, depending on the industry that you're in, and what that looks, how that risk looks to you. CME Group, in its current form, takes in the widest range of benchmark futures and options products across basically 6 asset classes, and I'm going to review those very quickly. If we look at the upper left-hand corner, you'll see a lovely ear of corn, and that's to represent agricultural products, and that's one of our asset class groups. Agricultural products and leading products in that class include corn, wheat, soybeans, as well as soy oil and soy meal, but also livestock futures based on swine and live cattle. There's also a dairy complex in the agricultural suite, as well as some fertilizer futures contracts. Moving across that top column, foreign exchange was the original financial futures contract developed by the legacy Chicago Mercantile Exchange in 1972. And we currently list standard futures and micro futures on G10 currencies, as well as emerging market currencies, of which the largest emerging market currency contract is the Mexican peso futures. Energy products, represented by WTI crude oil, but also natural gas and refined gasoline. Metals, represented by gold, silver, copper, aluminum, platinum, palladium, examples of our more heavily traded metals contracts. And moving down to the bottom section, interest rates, our largest and most heavily traded asset class, includes things like futures on U.S. Treasury securities, but also swaps futures, as well as short-dated interest rate products like SOFR, Fed funds, and Eurodollars. We also have a contract based on the Mexican FTIA rate. In equity index products, these include the major U.S. dollar stock market indices like Dow Jones Industrial Average, S&P 500, NASDAQ 100, and Russell 2000 indices, the subsectors of the S&P 500, and some newly launched contracts on some specialized sectors, as well as products like total return futures, dividend futures that are gaining in use by institutional participants due to changes in regulation and uncleared margin rules. And it's under the equity index asset class that we have both commodity index futures, but also the fast and rapidly growing crypto suite of products, which Giovanni's going to speak in greater detail on in the second half of our presentation. Our main role at CME Group is to develop deep pools of actionable liquidity in our standardized products in those 6 asset classes I just highlighted. And to do that, we encourage and try to draw in as many people from the trading spectrum as possible. Historically, our largest client base has always been people that come to CME to lay off risk. We sometimes refer to these people as hedgers. They're coming to our marketplace because they already have market risk. They want to sell that risk. And in order for them to sell it, someone has to be willing to buy it. Now, in many cases, that buyer of the risk could be another person hedging an opposite and opposing position. But in many cases, it requires an additional market participant, which we label a speculator. And a speculator in CME futures terms is someone who's willing to use capital to buy risk, to come into the market with new capital with the anticipation of being able to profit from it. They're not necessarily laying off risk, but they're going to be buying risk in anticipation of being able to profit from it. So the main purposes of our futures exchange business are 2 points. Price discovery in our major benchmark products, and this is done primarily through the central limit order book on our Globex electronic trading platform. And in the process of trade execution, transferring risk from one person to another. So the 2 main purposes of our business are price discovery and risk transfer. So where did we come from and how did we develop as a business and an industry, at least in the United States? It was based around agriculture. And Chicago, by being in the center of the country, but more importantly, because of its access to both water and rail transportation, by the end of the 19th century had become the focal point for both grain as well as livestock production, processing, and transportation. And as a result, we developed these large trading floors in exchanges, physical exchanges, with these trading rings, which we refer to as trading pits, where you had actual physical traders and brokers that engaged in what was called open outcry. And open outcry was basically what you're seeing in this picture of the old Chicago Mercantile Exchange trading floor, of screaming and shouting and using hand signals and so forth, transmitting information from phone banks via runners, giving physical paper orders to executing brokers, and then transferring the information back. This all changed after the change of the last millennium as we migrated to electronic trading and a electronic computer-driven central limit order book. This is what price discovery and risk transfer looks like today. It's a warehouse full of computer servers that works 24 hours a day, 7 days a week, in a climate-controlled environment that's very quiet and very organized, and has changed our business dramatically from that physically exchange location, regionally focused, central time zone, business hour focused, open outcry business to an electronically organized central limit order book that can operate 24 hours a day, 7 days a week. This central limit order book and electronic execution also greatly democratized our business. It made it accessible to the world in real-time terms. And this has completely opened up our business beyond our borders, beyond our region. And I mentioned it democratized the business in that you no longer needed to know a guy down on the trading floor. You can gain access to CME's prices and trading anywhere you have internet access. And that took what was basically a regionally organized physical exchange-based business and turned it into a truly global 24/7 internet-based business. Our legacy exchanges are the Board of Trade of the City of Chicago. Sometimes you may have heard the term CBOT or Board of Trade. The Chicago Mercantile Exchange, which is where we get our name, CME Group. And when they merged in 2007, they subsequently purchased, the new CME Group purchased the New York Mercantile Exchange, which had previously acquired the COMEX Exchange of New York. An interesting aspect of the mergers and the acquisitions is that prior to the creation of CME Group, each one of these legacy exchanges would have had their own clearing organization, which, if you think about this for a minute, any of our large commercial international commercial clients might have had positions on any of these 4 legacy exchanges, but would have had to put up capital at 4 different clearing operations. With the creation of CME Group, these large institutional and commercial users now can consolidate that risk into one clearinghouse, which has resulted in enormous capital efficiencies and reduction in capital cost for them to manage their risk. Our day is organized on a 23-hour trading day platform. The trading day at CME actually begins at 5 p.m. So, for example, today's session on the 25th of August began last night or yesterday late afternoon at 5 p.m. You can see on the far left of this slide, our day begins at 5 p.m. And rolling into today, right around about an hour and a half ago, about 11 o'clock Chicago time, the clearinghouse takes a little snapshot of all of our markets, and they do an intraday clearing cycle, which means any of the risk that accumulated between last night's open at 5 p.m. until about 10 or 10:30 Chicago time gets marked to market, and losers pay winners. And this is at the clearing firm level only. And this is important because it's part of the DNA or the background of the Chicago-based clearing business is that we don't allow loss carry forwards. We mark to market to our client base every day, but our clearing firms actually have to exchange capital on an intraday basis right around the middle of the day to eliminate any loss carry forwards that might have occurred from the 5 o'clock open until about the middle of our 23-hour day session. If you keep moving from left to right, you'll see all the way over to the 4 p.m. electronic trading closing. Then we get set up for the next day, and the cycle continues from Sunday night all the way till 4 p.m. on Friday afternoon. The orders themselves going through Globex also, because of this electronic execution now, we've been able to institute some very, very important risk management functions that would never have been allowed to exist because it would have been impossible to organize them in the old open outcry environment. And these include before an order can even get to the central limit order book, it has to be able to qualify to credit controls, a maximum order quantity, and its price must fall within, if the contract has price banding, within the banding requirements for that contract. And this is all designed as a pass-fail switch to prevent any kind of erroneous orders or orders that shouldn't be placed into the system from affecting the central limit order book. This has greatly reduced errors that would have occurred due to either fat finger input errors by pushing the wrong buttons on a keypad, or if a client were to exceed their credit controls imposed by the clearing firm and the Globex management system. If it gets into the central limit order book and it's matched buyer to seller, the message is immediately sent back to both parties that the trade has cleared. All of this is done within less than a millisecond of execution. That's the speed at which we're now doing business worldwide. And it doesn't make any difference whether the order takes place or originated in Hong Kong on the other side of the world, or if it's just down the street from our matching engine here in Chicago. PostTrade is when CME Clearing takes the lead role in post-trade risk management. And this includes things like putting a mark-to-market number on every one of our products every single day. And that's important because everybody gets the same price. So it doesn't make any difference who you are. The standardized futures products and options products all get marked to a specific price every day. The losers pay the winners. The money crosses through the settlement banking process, and all those positions then are recalibrated. And if margins need to be updated, then the clearing firms are responsible for getting that capital from the customer base. Clearing establishes initial and maintenance margins on all of our products, usually driven by market volatility and price action. But they do more than that. They also monitor all of the open positions in futures. They're also monitoring the risk profiles of all of our clearing firms, also monitoring the underlying markets on which our products derive their valuation. The structure at CME is sometimes referred to as an agency model, and that's what this slide is meant to show you. If you consider where most of our active customers are, they're over at the extreme right side of this slide. You'll notice that customers don't have direct access to Globex or the clearinghouse. That's by design. There has to be an intermediary, and the intermediary is, in our case, are clearing firms. Customers can't open up a direct relationship with CME. CME only does business with clearing firms, and clearing firms act as the intermediaries. They're the ones who exchange the capital, they establish the credit relationships, and they provide the facility or facilitate the access to CME's trading platforms and act as the agent on our behalf with respect to customers. This is an important differentiation in that in order to have access to CME's products and services, you have to have a relationship with a futures broker, and that futures broker may or may not be a clearing firm. But if they're not a clearing firm themselves, they must have a relationship with a clearing firm. We're a heavily regulated industry and have been for generations. Our chief regulator, as you're going to see in a minute, is the Commodity Futures Trading Commission, but we're also regulated to some degree by the Federal Reserve, our central bank, and we also have some self-regulatory responsibilities. Since the last great financial crisis, we've been designated a systemically important financial market utility, which is a very long-winded way of saying our federal regulators deem CME clearing to be a very, very important part of the capital market structure. And as such, they've given us the authority to self-regulate even down to the customer level on certain things. The structure of regulation goes back to the 1920s here in the United States, but the CFTC, which was created in 1974, is our chief and primary federal regulator. We also have dotted line responsibilities to the SEC, especially as they relate to our equity index suite, but primarily the CFTC is our regulator. So if I were to sum up my portion of today's presentation, it's to remind everyone that exchanges, futures exchanges, particularly CME, make a significant contribution beyond our marketplace in that we provide transparent and efficient price discovery. And in many cases, that price discovery feeds back into the markets on which our products are considered derivatives. We also, in that same framework, provide for very efficient and effective manner of risk transfer. People that come to us that want to sell the risk that they already have or manage the risk they already have in exchange to people who are willing to buy that risk. And then lastly, the function of the clearinghouse, an essential clearing organization, marking to market and establishing collateral levels for all open positions and making sure that our functioning system works properly all the time, every day, regardless of market conditions. That concludes my formal remarks. I'm happy to take any questions from the audience if you've got any, and also refer you to a few other items on our website. CMEgroup.com has a lot of very important information if you're interested in our business in terms of not just our products and our services, but there's an educational portal called CME Institute that you can find under the educational tab on our website. Can I take any questions at this time? If not, I'll pass it to Giovanni.
I think we have a question in the chat. From Rodolfo Hugo. He says, what is the minimum margin to buy micros?
Okay, micros are futures contracts, standardized futures contracts that have a smaller notional equivalent size than the standard contracts of the same name. So for example, we have micros on gold futures, we have micros on equity index futures, we have micros on some of our grain products. The margins are on the website You can find them. Now, be mindful that the margins that you're going to see at cmegroup.com reflect the margins to the clearing member. The clearing members, because they assume credit risk and also have that intraday mark to marking that customers don't have by right, and in many cases have the responsibility to ask for margins greater than what you're going to see on our website. That's because they've got that intraday margin risk. But the margins, depending on the size of the micro contract relative to its standard contract, are going to be smaller. You just simply have to find the micros on the website.
Rodolfo's microphone doesn't work, but he asks after the previous question, so I'd be buying to Sigma?
I don't understand what that means. We have micro contracts on most of our asset classes, but they are, I think I get the question now. Is it, no, you would not be margining with, and I think that's, is it a Signa? What's the clearing house in Mexico?
Yes, the clearing
Yes,
house.
a Signa. No, the margining on anything at CME is always going to be through CME clearing. And again, going back to that slide on our structure, that has to be done through a clearing firm intermediary. So to access any of CME's products, you're going to have a futures trading account with a qualified FCM, which is short for Futures Commission Merchant, which is a fancy way of saying a futures broker. And that broker must have a relationship with a clearing firm that can give you the access to CME products. CME Clearing will be the counterparty, not a Signa.
He says, thank you, it was really helpful.
Anyone else? Anything in general or specific? If not, then I will gracefully back out of the conversation and allow Giovanni to continue.
Hi, can everybody hear me? I was having some connectivity issues there.
I can hear you now.
Yes.
Perfect. Perfect. Sorry about that. And David, thank you so much for that great overview of CME Group and what we do. Now there was a question there on margining, so it's for micros. So I don't know if that question, say, was specifically for our micro Bitcoin and micro Ether futures contracts. If so, the exchange minimum margins for those contracts are 26% and 29% respectively. So 26% for micro Bitcoin, 29% for micro Ether. So if we look, say, at the price of Bitcoin currently, it's roughly 21,500. Our micro Bitcoin contract is 1/10 of a Bitcoin. So on notionally adjusted, that contract is worth about $2,150. So the margin, the exchange minimum margin that would need to be posted for exposure to one micro Bitcoin contract is approximately $560 per contract. But we'll get into that a little bit later in the presentation. Now let me see if I have the ability here to share. Bear with me. And let me know if everybody can see that.
Yeah, seems that we have it here clearly. I can see it at least. And depending on how you feel, amigo Gio, you may do some of the presentation in Spanish. Most of the audience will be in Mexico, right? So depending how you feel your Spanish.
Yeah, my Spanglish, better yet. So I do want to keep this interactive as best we can. So please feel free to use the chat function to submit any questions. And I'll do my best, to address those questions as the presentation goes on. Similar to what David shared, we do have a disclaimer. Legal team suggests that we show this. Just bear in mind that anything that's shared today is more for illustration purposes. So we're not making, any recommendations on, how to trade these products. And bear in mind that trading, futures and options on futures do carry their own level of risk. So when we look at CME and the evolution of cryptocurrency products at CME, our story really begins around 2015. Right. So in 2015, we began working with a firm, CF Benchmarks. They are a regulated benchmark administrator out of the UK under the authority of the UK Financial Conduct Authority. Right. Now, with them, we helped construct reference rates. In this case, our first reference rate was the Bitcoin reference rate. And that reference rate was really created to provide the marketplace with price discovery for, the price of Bitcoin, right? Now, in 2016, we actually launched that reference rate, and then followed up as we saw, more client interest in this underlying new technology, this underlying new coin. We launched our first Bitcoin futures contract in December of that year, right? Now that Bitcoin futures contract is a cash settled contract. So there is no exchange of physical Bitcoin. It is a contract that settles to the price of that CME and crypto facilities Bitcoin reference rate. Now we followed in 2018. We introduced, as we saw, more interest in other cryptocurrencies beyond Bitcoin, we introduced an Ether dollar reference rate in May of 2018. So really providing, the same level or the same type of price discovery transparency for Ether as we did for Bitcoin. We followed in 2020 with options on Bitcoin futures. And then really in 2021, as we saw, more institutional interest for our cryptocurrency products, we introduced futures on Ether. We also introduced micro Bitcoin, micro Ether futures, and also some mechanisms on how to trade, how to access those futures contracts. We introduced a mechanism called basis trade at index close. Similar to our Bitcoin futures contract, our Ether futures contract is cash settled. It settles to the CME and crypto facilities Ether dollar reference rate, and similarly, the micro contracts also settle to their respective reference rates. Incidentally, our Ether futures contract represents 50 Ether, while our micro contracts, both Bitcoin and Ether, represent 1/10 of a Bitcoin and 1/10 of an Ether. Now, this year, we've actually been quite busy at introducing products, whereas last year we introduced a product every quarter. This year, we've been introducing a crypto-related product or functionality every month. In fact, since December of last year, we've introduced, this would be actually our 10th month that we've introduced a consecutive or 10th consecutive month that we've introduced a crypto-related product. So far this year, we've introduced options on our micro Bitcoin, micro Ether futures. We've also introduced 11 new additional cryptocurrency reference rates. So following, say, the same principle that we did for Bitcoin and Ether, we now have reference rates on things like Cardano, Solana, Polkadot, just to mention a few. This coming Monday, we're actually going to launch Bitcoin Euro and Ether Euro futures, and those are based on reference rates that we launched a little bit earlier this year. Now, why are we introducing all these products? Well, it really comes down to the client interest. When we look, looking at the chart here, we're seeing, according to CoinMarketCap.com, there are over 20,000 cryptocurrencies offered globally across 500 different exchanges around the world. Now, why is that happening? It really comes down to how customers, or the potential, I should say, for these new technologies and coins to really change the way we think about money and really that transfer of value, right? When we look, say, at the collective market capitalization of these coins, at current levels, they exceed, say, about USD $1 trillion, with the top 5 coins representing north of 80%. But I will mention that they're heavily concentrated toward, or market capitalization is heavily concentrated towards Bitcoin and Ether. Now, an interesting comparison, I like throwing this up to show, for example, how Bitcoin, Ether, cryptocurrencies compare to other markets, right? So this chart here, we're looking at different market capitalizations in Q4 of 2017. So just before, for example, just before we launched our Bitcoin futures contract. So we could see that at that time, Bitcoin had a market capitalization a little bit over $100 billion. All cryptocurrencies were a little bit over 250 billion. But you could see that those numbers really pale in comparison, say, to the amount.
Sorry. Could you share it in full screen, please?
It's not a full screen. Hold on. You don't see it in full screen?
No.
Gio, click on at the bottom where that little presentation podium
is that better? Is that better?
There.
Thank
now
you.
Let me just.
You're just going to have to scroll down to the slide you just finished. There you go.
My apologies for that. I thought that it was on a full screen earlier, so my apologies. Yeah. So when we look at this chart, then we could see that in Q4 of 2017, really the market capitalization for all cryptocurrencies and Bitcoin really paled in comparison, say, to the amount of US dollars that's in circulation, really paled when compared, say, to stocks such as Apple and Amazon. But if we go to the next slide, this is taking a snapshot of this current quarter, we could see now that the market cap for all cryptocurrencies are really now on par, say, with the market capitalization of say, an Amazon, right? Further, we can note that the value or the increase in market capitalization for cryptocurrencies and Bitcoin has increased by a factor of 4 compared, say, to where we were in Q4 of 2017. So we're really seeing that there has been, say, really increased demand in these coins, and we could see, say, that translate into increases in market cap. One thing for sure is, if we look at Bill Gates' net worth, his net worth has gone up about 30%. Cryptocurrencies have gone up over 4 times in from 2017 to 2022. So my recommendation to Mr. Gates is maybe he should be investing perhaps in some cryptocurrencies. But when we compare, even at current levels, and these levels are down, say, from the highs that we saw toward the end of last year. If cryptocurrencies, particularly if Bitcoin is to challenge, say, gold as a store of value, we can see that there is the potential for a lot of further growth when we look at the gold market capitalization there at about $11 trillion. So just taking a look at how Bitcoin in particular, or cryptocurrencies, say, have performed since 2016, we could see from this chart that it is a very volatile market. So, we see that there are peaks, valleys, ups and downs. The peak capitalization for the cryptocurrency market was toward November of last year, where it approached almost $3 trillion. We could see that currently we're in a bit of a down market. Both Bitcoin and Ether were down over 70% earlier this year. They have made a bit of a comeback, maybe recouping 15 to 20% from those lows. But we can see that both Bitcoin and Ether do control, say, most of that of the market cap, with Bitcoin representing at current levels about 40% of the entire cryptocurrency market capitalization, and Ether representing, say, about 20%. Right. So why is there this interest then in cryptocurrencies? What are some of the benefits that the marketplace, say, perceives? Right. I think when you look, say, at this new technology, right, there's a few things that really pop out. One, the technology is decentralized, so there's no company, no government can control, say, the blockchains or the respective coins and tokens, right? The information that's stored on these blockchains is immutable. So that means that once a transaction is posted to the blockchain, it can't be changed. So it's there, it's transparent, it's for everybody, say, to see. I think when you look, say, at say the value, say, of cryptocurrencies and blockchain technology to really act, say, as a form of currency, the power is really there, particularly when you look at or consider how many people globally are unbanked. And according, say, to the World Bank, there's 1.6 billion people globally who do not have, say, banking relationships. And that is something, for example, that cryptocurrencies, Bitcoin in particular, could look to change. I mean, when we look at Mexico, I read something where about 60% or so of the population is unbanked. Right. So cryptocurrencies, particularly on economies that rely, say, on remittances for their GDP growth, we've already seen in LATAM, El Salvador, a couple years ago, introduced Bitcoin to sit alongside the dollar as say, that country's tender. El Salvador is a small country, but it really did. I think establish, say, a tone for other countries to follow. And we've seen the Central African Republic, for example, also recently accept Bitcoin as a form of legal tender. When we look at say, globally, how many people, say, either know or have traded, say, cryptocurrencies. I saw a recent figure that this year, it's expected that about 1 billion people globally will have, say, transacted, Bitcoin or other cryptocurrency. So one thing's for sure is that this is a technology that is, I think, too big to ignore at this point. And it's something that, not just, say, the retail community, but also institutions have to take a closer look at. So how does the marketplace currently access cryptocurrencies? In an earlier slide, I showed, according to CoinMarketCap, that there's over, say, 20,000 different coins, over 500 different exchanges globally. In Mexico, for example, the Bitso exchange exists, where citizens can open up an account and easily trade Bitcoin, Ether, or any other, say, cryptocurrency, right? But access, say, to Bitcoin or cryptocurrencies is available, say, through these various spot exchanges, but you can also transact it peer-to-peer. Really, all you need is one, establish a wallet, a set of keys, and once you have that, and you could, say, purchase an item and purchase that item or sell an item, say, in exchange for Bitcoin or Ether, right? And you could simply just store that in your wallet. If you decide that you want to sell that on an exchange, you simply open up an account with an exchange, and you're able, say, to easily transfer and, say, transact out of Bitcoin or into cryptocurrencies at your exchange of choice. In addition, say, to spot exchanges and peer-to-peer, there's also, say, different products. Not everybody, say, has the comfort level to maybe open up an account at a spot exchange or the technological savvy to establish, say, a wallet, to be able, say, to hold crypto. Some folks, some entities, individuals, institutions prefer, say, to get their exposure through other means. There are now many, say, Bitcoin and Ether ETFs in Canada. In the North American markets, Canada pioneered the ETFs. They were the first on this part of the world, anyhow, to introduce a Bitcoin ETF. They also introduced Ether ETFs. Of course, in the U.S., last October, we introduced Bitcoin futures based ETFs. In Brazil, there are index crypto ETFs as well as Bitcoin ETFs. There are also, say, various over-the-counter markets where market participants can look, say, to trade or get exposure to crypto, as well as many, say, unregulated derivative platforms that also offer what are called, say, perpetual swaps and other, highly, say, levered products. But of course, today we're going to speak a little bit more about futures and specifically Bitcoin and Ether futures contracts that are listed here at CME. Right. So before doing that, maybe just a quick review, say, of what is a futures contract, right? So the beauty, say, of Bitcoin and Ether futures listed at CME is really that the contracts would be no different, say, so if you're already trading E-mini S&P, for example, trading, say, Bitcoin futures or our micro Bitcoin futures is really going to be no different from an experience perspective than trading, say, that S&P 500 contract. So it's something that you would already, say, be familiar with. But a futures contract is a standardized agreement to purchase or sell a commodity at some point, say, or for delivery at some point in the future, right? In the case of our cryptocurrency futures and options on futures, bear in mind that all our products are cash settled products. So they settle to an index. There is no exchange of Bitcoin, no exchange of say, Ether, right? So the contracts have standardized terms. In the case, say, of our cryptocurrency products, we offer 6 consecutive monthly contracts. We also recently added 4 additional quarterly contracts, and we'll always list, say, 2 December contracts. So really what that means is that the market participants now have the ability to see price discovery along the curve, right? So if a market participant, say, is interested in getting longer term exposure to the price of Bitcoin or Ether, they can go out and trade a contract that is at least a year away, right? So it really gives market participants a lot more flexibility, and also provide, say, that price transparency and price discovery to the marketplace. Tick sizes are also standardized. In the case of Bitcoin, our tick size is $5 per Bitcoin. In the case of our Ether contract, it's 50 cents, say, per Ether. Right. Our contracts then also establish, say, a standardized settlement mechanism. In the case of our cryptocurrency products, our contracts settle on the last Friday of the contract month, and they settle at 4 p.m. London time. And I'll get into that a little bit later as well. And a few terms that we tend to throw out when speaking about futures contracts. We talk about average daily volume. We talk about open interest. So average daily volume is the amount that is traded on any given day. And open interest represents the amount of positions that either long or short that are open and market participants haven't traded out of yet. Right. So a quick comparison, say, between, say, futures or cryptocurrency futures contracts, say, versus the spot markets. So of course, with say, our suite of cryptocurrency futures, there is no requirement, there's no need, say, to establish a wallet, right? So that also means, for example, that if you establish a wallet and, say, you lose those keys, you have, say, permanently lost access to the cryptocurrency that was in that wallet, right? With getting your exposure through a CME cryptocurrency futures contract, you don't have that risk. You don't have the need, say, to establish, say, that that wallet. Futures contracts are levered contracts. Right. When we look, say, at our Bitcoin futures contracts, which represent, say, 5 Bitcoin. So looking at the price of Bitcoin currently being around $21,500, one futures contract then would have a notional value of about $107,000. Now, you don't need a market participant that goes to trade our product, doesn't need to post 107,000. They need to post, and we spoke about this a little bit earlier, they just need to post margin for that contract. And currently for Bitcoin, the exchange minimum margin is 26%. It is 29%, say, for Ether futures. So to get exposure, for example, to one CME Bitcoin futures contract, which again represents at current prices over $107,000 notional, a investor would need to post a little bit less than $28,000 to get exposure to that contract. So when you look, say, at the amount of leverage that investors receiving, they're getting about close, say, to 4 times leverage by using our contracts. Our futures markets are regulated markets. So as David mentioned earlier, our regulator is the CFTC, and they oversee, say, all our products, not just cryptocurrencies. For U.S.-based investors, there are, say, some tax efficiencies in that futures have a 40-60% long-short tax treatment. Right. In addition, and as David explained in his presentation, our clearinghouse offers various risk mitigation tools. We spoke a little bit about margin, but in addition, say, to margin, we also establish, say, position limits. We also establish, say, price limits as well. Lastly, for any entity, for example, that wants to say obtain short exposure to say Bitcoin and or Ether, it is much easier to do that, say, with a futures contract rather than trying to do that in the spot market. In the spot market, entity would need to actually find somebody that is willing to lend them that cryptocurrency in order for that entity to be able, say, to short sell. With a futures contract, it's just as easy as, you sell a contract, you are automatically short that contract. And now, I mentioned earlier that our futures contracts are all cash settled contracts, and they settle to their underlying respective CME and crypto facilities reference rates. But maybe a little bit, going a little bit deeper, say, and explaining what those rates are, right? So the Bitcoin and Ether reference rates are once a day references to the US dollar price of, say, 1 Bitcoin and or 1 Ether. All right, and that price represents the actual, say, transaction value, or the actual price that market participants are buying and selling Bitcoin and Ether across 6 constituent exchanges. So those exchanges that are tracked by our reference rates are Bitstamp, Coinbase, Gemini, Itbit, Kraken, and LMAX Digital. Collectively, those exchanges represent north of 70% of, say, dollar Bitcoin, dollar Ether transaction. Now, the calculation agent for these indices is CF Benchmarks. As I mentioned earlier, they are a regulated entity out of the UK, and the methodology, say, that they use to say to publish these reference rates is really very robust, resistant, say, to manipulation. What they do every day between 3 and 4 p.m. London time is that they look at dollar Bitcoin, dollar Ether transactions that are occurring on each of those 6 exchanges that I mentioned earlier, right? They split that hour into 12 5-minute buckets, and then at each 5-minute interval, they are calculating a weighted median price of all the Bitcoin, Ether, dollar Bitcoin, dollar Ether transactions that occurred at those exchanges. They then take those 12 observations and take a simple straight average, and then that becomes the reference rate for that particular day. That reference rate is published daily at 4 p.m. London time, and our futures contracts settle to the price of that rate on the last Friday of the contract month. Additionally, these reference rates have an oversight committee made up of 7 or so industry experts. So that committee has responsibility for ensuring that the methodology is being maintained, as well as other criteria. For example, the committee also determines the criteria for how an exchange is considered for inclusion in the reference rates. And the inclusion criteria for these exchanges, they have to maintain a certain level of volume. They also have to have KYC, anti-money laundering provisions in place. They also have to have readily accessible API connections, as well as agreeing, say, to sign information sharing agreements with both the index calculation agent, CF Benchmarks, but also with CME Group, in case, for example, that we have, say, any regulatory inquiries, we can easily have access, say, to who has traded at these spot exchanges. So let's take a look at how, say, our cryptocurrency products are performing. Right. So when we look at Bitcoin futures and options, we can see that since we launched, we see a fairly strong and consistent growth from year to year. Currently, Q3 of this year, we're averaging just under 11,000 contracts or so per day. Open interest is a little bit over 13,000 contracts. Now, to put, say, those numbers in perspective, recall that Bitcoin futures represents 5 Bitcoin. So we're talking then on an equivalent Bitcoin terms that we're averaging close, say, to 55,000 equivalent Bitcoin per day. If you compare, say, that number to the average number of Bitcoin that is traded, say, at Coinbase, Bitstamp, constituent exchanges, we generally trade more in equivalent Bitcoin terms than each of those exchanges. And I'm only talking, say, Monday through Friday volume and only looking at the dollar, so Bitcoin dollar, Bitcoin euro pair. In fact, last year, 80% of the time, our equivalent Bitcoin volume exceeded the combined volume of the constituent exchanges 80% of the time last year. When we look, say, at open interest, CME Group futures open interest, for Bitcoin, usually ranks amongst the top 3, and that's when compared, say, to some of the unregulated derivative platforms such as FTX, Binance, for example. But our open interest usually ranks top 3 when compared to those. Since we've launched, we've had over 10,000 unique accounts trade our Bitcoin futures. Another measure that we track, and something that's calculated by our regulator, is the number of large open interest holders. Now, that is any entity that holds at least 25 contracts, right? So if we consider the notional value of one contract currently being a little bit over 100,000. So we're talking about at current levels, somebody that's holding about $2.5 million in terms of notional. But we see that number has averaged 98 holders in 2022, and that's up strongly from where we were last year. Last year, we averaged about 80 such holders. So that's really an indication that we're seeing, say, more institutions look, say, to either gain exposure or manage, say, their crypto risk through our Bitcoin futures contracts. Bitcoin options, since we launched those options in January of 2020, we've traded a little bit over 75,000 contracts. 21% of that volume is coming, say, from outside the U.S., and about 17% of that trading occurs before the U.S. regular trading day begins. We spoke a little bit earlier about, say, micro Bitcoin futures. We launched that product in May of 2020 last year. Since we've launched that contract, and again, those contracts represent 1/10 of a Bitcoin. So in terms of notional value, it's a little bit, say, over $2,100. So it's $2,100. So it's very accessible to the retail community. But we also do see institutions use our micro contracts because it's easier, say, for market participants, for example, to fine-tune their exposures. They don't have to wait, say, to accumulate a 5 Bitcoin position. They could hedge or gain exposure using, say, the smaller size contract. We're averaging a little bit over 17,000 contracts per day, and open interest is averaging a little bit over 20,000. The contracts themselves have been, say, volume additive, meaning that we're seeing, say, market participants trade both the large contract and the micro contract. We're not seeing, say, market participants look to cannibalize, one contract or another. On May 19th of last year, we saw a record volume of close to 95,000 contracts, and open interest reached a high, a little bit over 65,000 contracts toward the end of October. Similarly, we see, say, large open interest holders averaging a little bit over 100 such holders, but just bear in mind that the definition, say, for a large open interest holders, it's 25, regardless of whether you're holding, say, the large Bitcoin futures contract or the micro Bitcoin futures contract. Looking at Ether futures, that product was launched in February of last year. We've traded close to 2 million contracts since launch. That contract represents 50 Ether. So we've traded, over 90 million equivalent Ether in that time. We're averaging this quarter about 7.5 or 7.5 thousand contracts per day. Open interest is averaging close to 4,000 contracts per day. We did have record volume of over 25,000 contracts earlier in June. And similarly here, we're seeing, say, that number of large open interest holders grow. We averaged 46 such holders, or are averaging 46 such holders year to date. But just to comment on that, and then you can see there from the slide that we had a record of 58 holders the week of November 9th. But just to comment on that, so we launched Ether futures just last year, so about a year and a half ago. It took Bitcoin futures over 2 years to achieve more than 50 large open interest holders. It took Ether futures less than a year to achieve that same feat. So the reason why that's important is because we're seeing you're seeing, say, growing comfort with, say, both retail and institutional investors on cryptocurrencies, with Bitcoin, say, perhaps being that on-ramp, and then Ether, say, being that second by market capitalization, being that quick follow, right? But we're also seeing, though, that the community is really adapting more to these new technologies and these different these new coins. Micro Ether futures have also been doing quite well. Those were launched just December of last year. Similar to Bitcoin, their size at 1/10 of 1 Ether. But when you look, say, at the relative notional size, if you recall, say, with micro Bitcoin, that notional value is currently around $2,100. So micro Ether notional value is at current levels is roughly is less than $200. So it's a relatively a very small notional size contract, right? That we've traded over 3 million contracts since we launched. We're averaging a little bit over 22,000 contracts per day, with open interest averaging about 47,000. Earlier this year, we launched options on our micro Bitcoin, micro Ether futures contracts. Right, we're seeing, since launched, we've had more than 45,000 contracts trade, or 45,000, say, micro Bitcoin contracts trade, and over 141,000 micro Ether options trade. Now, a quick point on this, and a lot of you may have heard, say, of the upcoming, say, merge that will affect the Ethereum blockchain. And what that means, for example, is that the Ethereum blockchain is moving, say, from a proof of work to a proof of stake consensus mechanism, right? So that will make Ethereum much more, say, green, so more ESG friendly. It's also going to make that blockchain more scalable, faster, more secure. right? But it is generating, I think that, and this event is currently scheduled to occur on September 19th. But I do believe that it's one of the most anticipated events in the crypto market since, say, the launch of Bitcoin, or the introduction of Bitcoin back in 2009. So this will be the first time, say, that a blockchain moves, completely changes its consensus mechanism. So, we are seeing market participants use particularly our micro ether options products, say, to position themselves for that event next month, either, say, to manage risk or just gain exposure. In fact, our micro ether options contracts reached record open interest. I think exceeds now 106,000 contracts, and that open interest has more than doubled since last month. We've also seen a very strong pickup in terms of average daily volume for those contracts as well. We were averaging this month. We're actually averaging a little bit over 60,000 contracts. So when we look, say, at how our contracts trade, globally, when we look, say, at Bitcoin futures, micro Bitcoin futures, we have, say, over 100 countries, or participants trading, say, from over 120 countries. We see for Bitcoin futures about 33% is traded during overnight hours, and incidentally, we define overnight hours to be 5 p.m. to 8 a.m. Central Time. All right, about a little bit over 40% of, say, Bitcoin futures volume comes from outside the U.S., with the bulk of that really coming out of, say, EMEA. Followed by APAC, and LATAM is currently, say, underrepresented at, say, 1%. We see, say, kind of like similar numbers for micro Bitcoin futures. 35% is traded overnight. We see, say, slightly higher coming out of APAC, and less coming out of EMEA currently. Ether futures, over 40% of that contract is traded during overnight hours, and 42%, say, is coming from outside the U.S. And you could see there that there's a lot of interest, say, in Ether coming out of EMEA, which currently represents about 33% of volume, followed by APAC at 11%. And similarly there, you could see on the chart how micro Ether futures and options are performing, globally as well. Now, I spoke a little bit, when explaining, say, the underlying reference rate. If you recall that our reference rates are calculated between 3 and 4 p.m. London time. If you look, say, at this chart, and this chart is showing the hourly Bitcoin futures volume, and it's really tracking, say, from when we open our markets to when we close. And incidentally, our markets are open. We open, say, our futures and options markets at 6 p.m. New York time, Sunday evening, and that market remains open until 5 p.m. New York time, Friday evening. And every day between 5 and 6 p.m. New York time, we're closed, say, for maintenance. But if you take a look at this chart, you can see that the most popular, or the highest liquidity hour for Bitcoin futures really coincides with that, and the chart here, incidentally, is in Central Time, so that 9 to 10 a.m. Central Time. That hour corresponds to the 3 to 4 p.m. London time calculation window for the reference rates. So you could see that the liquidity for the futures contracts, that highest volume hour coincides exactly, say, with the calculation of that reference rate. And that's really because, during that time, you've got, say, the EMEA European markets are open, the U.S. market is open, and you're still getting some activity from the Asian markets as well. Additional here, and what's interesting to point out is that you see, say, that 2 to 2:59 p.m. Hour, and you could see that there's a bit of a pickup in that hour, say, relative to the couple hours before. What's interesting here is that with the introduction of the Bitcoin or Bitcoin futures-based ETFs, both in the U.S. and Canada, we're now seeing, say, more activity or more volume, say, traded between, say, 3 and 4 p.m. New York time as a result, say, of the net asset value calculation for these various ETFs. And this chart is really just showing the same, but showing, say, the hourly distribution for Ether futures. But here again, you could see that, the high volume hour tends to coincide with the calculation of the reference rate. And bear in mind that depending, say, on daylight savings time, it'll either be, say, 8 to 9 or 9 to 10 Chicago time. And now I thought it would be good, say, to maybe go, say, through some use cases and maybe say a couple examples, right? So when we look at who uses our contracts, I'd say that our contracts, we have a very, say, diversified mix of participants. So we have, for example, the traditional proprietary trading firms that provide, say, liquidity, right? So those are firms, for example, that may be trading other CME futures and options contracts that are then also providing liquidity for our cryptocurrency products. Right. We have also attracted, say, crypto native platforms. So, for example, the lending and borrow platforms, as well as crypto focused funds. So funds that are strictly investing in cryptocurrencies. Is everybody still there? As my screen went blank a little bit. Just.
Yes, we are still here. Don't worry.
Oh, perfect. Because I saw something go blank. Okay, great. So we've also seen, say, crypto native funds trade our products. Beginning, say, in the summer of 2020, we started seeing, say, more of the macro hedge funds, so long, short strategies, for example, trade our product, as well, say, as some of the larger asset managers, right? And how are some of the ways, say, that these participants are using these contracts? So when we look, say, at the prop firms, they're primarily using our market, say, to provide liquidity, so buying and selling, maintaining a spread, right? When we look at hedge funds, could you maybe using, say, our products, say, if it's a relative value hedge fund, they would use our contract, for example, to be able, say, to execute arbitrage strategies. When we consider, for example, that cryptocurrencies are listed on 500 plus exchanges, in addition, say, to all these derivative platforms that exist globally, and then some of the other products, ETFs, ETNs, for example. So there is various prices and various multiple opportunities for hedge funds to arb across all these different products, right? Additionally, we see retail participants, particularly with our micro contracts, use our contract either, say, for exposure to benefit from the leverage, but as well as using it, say, to potentially arb against other positions. Bitcoin miners. So a miner is an entity, for example, that is say approving say transactions that occur on the Bitcoin blockchain. So every 10 minutes, there's a new block that is created, and the miners are the ones that are verifying those transactions by solving these cryptographic puzzles, but every time that a miner, say, successfully verifies a transaction, they get rewarded with, say, Bitcoin. And then they have, say, they're exposed, say, to that price of Bitcoin. So miners, say, would be natural hedgers, as they have an incentive, say, to trade a futures contract in order to protect any downside risk that they have. We also see corporations, but albeit, say, still early days, but anybody, for example, who's accepting cryptocurrencies, Bitcoin and Ether, as a form of payment, then has a need to use futures contracts, for example, to hedge those transactions. When we look, say, at Ether, the Ether blockchain is a blockchain that allows developers to write applications on top of that blockchain. Currently, there are over 200 plus projects, so decentralized finance projects that are using, say, that blockchain. So all those developers, for example, they need, say, Ether, because Ether is the currency of that blockchain. So they need Ether essentially to run their various applications. And as well, they're exposed, say, to the volatility in price and can also benefit from using, say, our futures contracts. So let's just take a look on, and these are strictly, say, for illustration purposes, but I thought it would be good maybe to show an illustration of say, a short trade as well as a long trade. So I spoke a little bit, say, about miners, right? So miners would naturally be long Bitcoin, right? So any miner, for example, that is concerned with the price of Bitcoin declining, all they simply need to do is sell a Bitcoin futures contract, and that helps give them protection against a decline in price, right? So in this case, Bitcoin is currently trading around $21,500. So let's say, for example, that a miner wants, say, to protect 5 contracts, and bear in mind that 5 contracts, and each contract represents, say, 5 Bitcoin. So in this case, the miner is protecting themselves against 25 Bitcoin. So that miner sells 5 contracts at a price of $21,500, right? When we look, say, at the notional value of each futures contract, the notional value of each contract is about $107,000. He has 5 contracts, so that's a little bit over, say, $500,000 notional, right? Now, we spoke a little bit about margin. Bear in mind that margin can change, but at current levels, margin is minimum margin is 26%. So for each contract, that miner would need to post about $27,950 per contract. So in total, if we multiply that by 5, in total, they would need to post a little bit over $139,000 to get exposure, say, to that 5 contract position. Now, so let's say that just to summarize. So assume that the miner sold the contracts at $21,500, and then come September, for example, let's say that the price of Bitcoin futures goes from $21,500 to $20,300, right? So just to summarize, the miner sold 5 contracts at $21,500. Those contracts at the end of September are trading at $20,300. Remember that client was short, so they've been able to gain on their futures position $1,200, say, per contract, because the price dropped. We take that gain, multiply it by each contract is 5 Bitcoin. They had, say, purchased 5 contracts. So the miner's profit and loss on that trade in this example would be $30,000, right? Now, that $30,000 that the miner gained from the futures position goes to offset the amount that the miner is losing on his physical or her physical Bitcoin position. Because remember that in their physical holdings, the price dropped from 21.5 to 20,000. So they have a loss there, but that loss would be offset by the gain in futures. And just you know, a good way of thinking about this, you know, I spoke a little bit earlier about, say, the minimum tick size for a Bitcoin futures contract, which is $5 per Bitcoin. Each contract represents 5 Bitcoin, so that's $25. So every time the price of Bitcoin changes by 5, that represents, say, $25 per contract. So if it's a $10 move, it's $50 per contract. $100 move, $500. $1,000 move, you know, we're talking about $5,000 per contract. And keep in mind that our futures contracts settle on the last Friday of the contract month at 4 p.m. London time, the time you know when say the underlying reference rate is published. So if a market participant either buys or sells a contract and doesn't offset that position on final expiration date, that contract would settle to whatever the price of the underlying index was. Looking at, say, a long Bitcoin futures example, let's consider, say, a trader who expects that Bitcoin is going to rally, is going to increase in price. So she decides then to gain her exposure via, say, a Bitcoin futures contract using the same price that we used before. Assume that Bitcoin's currently trading at 21,500. In this example, the trader goes long one contract, one September contract. So goes along at 21,005. So the and apologies there because looks like there's just a typo on the notional value calculation there. But the notional value of that one contract is $107,500. She would need to post 26% or $27,950 for exposure to that one contract, which represents the 107,000, right? Also bear in mind, when I speak about that exchange minimum margin, that is the minimum amount that the exchange requires. But as David mentioned earlier, the clearing firm that the client uses may ask, say, for a greater margin. Right. So let's say that at the end of September, the futures contract is trading at 22,700. Right. So the trader in this case purchased Bitcoin futures at 21.5. So they're actually making a profit of $1,200 per Bitcoin. Bear in mind that each contract represents 5 Bitcoin. So in this case, the trader is making about $6,000 profit so far. Bear in mind that in these examples, I'm using, say, positive results, but of course, positions can move against you as well. And in that case would represent a loss. So now, let's assume that this particular trader holds the contract until final settlement date. So September 30th is the last Friday of the month. Let's assume that she holds a position until then. So further assume that the BRR, so the Bitcoin reference rate, settles at $23,710. The initial purchase price was $21,005. So in this case, the trader would have made $2,210 per Bitcoin. So per contract, each contract representing 5 Bitcoin, the total profit on this particular trade would exceed a little bit over $11,000. So that concludes what I wanted to share. In the appendix, we do have additional information showing, for example, some of the contract specs, as well as other resources that are available. But I'll pause there and see if there are any questions.
Giovanni, can you see the chat window?
Help me out here. Where do I see it?
On the bottom, on your toolbar at the bottom, if you click on the chat function, you'll see.
There's a couple of questions there, yeah. Please.
Oh, hold on. Let me exit because I'm seeing
If
something at the
not,
bottom, but I don't see.
yeah, well, let's try this. How would you, why are cryptos classified in the equity index asset class rather than FX?
Oh, sure. Hold on. I just exited and seeing if I. Oh, now I could see. Yeah. So great question. So at CME, so I work, for example, in equity products and alternative investments. So we cover essentially index-based products. The majority of those being, equity indices, but we also have products on commodity indices, a water index. The futures products or the cryptocurrency futures products that we offer are index-based products. So these are products, for example, that are based on an index calculated by CF benchmarks. So that's the reason, say, why we have, say, Bitcoin futures, Ether futures under the equity group. Now I know, say, when we look across, say, banks, for example, are currently getting more into the crypto space, and I've noticed that within banks, it's a combination, say, of the equity derivatives desks. So the Delta One desks that are looking to offer exposure, but in addition, say, to those desks, we also see interest coming out of the FX desks at those banks as well. And some of those banks are looking at things, for example, as non-deliverable forwards, like non-deliverable Bitcoin forwards, for example.
Thank you. May I ask something else?
Of course.
Thank you. Is the margin model similar to the other underlying assets, or you have to make something brand new for the cryptocurrencies?
Yeah, so it's a great question. Similar, say, to what we had discussed earlier, for example, with contracts being standardized, and say a trader that's familiar with trading S&P should be familiar, say, with trading a Bitcoin futures contract. In terms of our margin calculation, that's all handled by our clearinghouse, by our risk department, and our risk department uses, say, the same criteria, the same model. So they use a span model to calculate margins for both Bitcoin and Ether. Bear in mind that these cryptocurrencies are highly volatile. At one point, Bitcoin and Ether were in excess, say, of 100% annualized volatility has come down. And with volatility coming down, so too have, say, the exchange minimum margins. In fact, when we launched Bitcoin futures in December of 2017, the exchange minimum margin was about 40%. When we launched Ether in February of last year, margin was in excess of 45%, and we're now, say, at 26% for Bitcoin and 29%, say, for Ether. But yes, we follow the same model.
Great, thank you.
Gio, there's another interesting question on the chat. Maybe it was related to the previous one. I don't know if you already touched upon it, but it was how would you value a crypto?
That's a great question. So I think when you look, say, at say the futures contract itself, right, and futures contract is going to track, say, the price of Bitcoin and Ether at these various, say, spot exchanges, right? I'll look to answer that question by maybe say explaining how the futures price itself is derived. And maybe add a little bit in terms of say how the underlying, say, cryptocurrency itself may be valued. But if you think, say, of a participant who comes to our market to gain exposure, say, to to Bitcoin. somebody has to sell them that exposure, right? So remember that futures contract, a futures is a contract, right? So the entity that's selling that contract, right, would need, say, to hedge themselves. And if they need to hedge, essentially what they're going to do, if I want to buy Bitcoin futures, the hedge for somebody who's selling me a Bitcoin futures contract would be that entity would need to, say, buy Bitcoin, right? And we know, for example, that Bitcoin is currently trading around $21,500. Now, if I want to buy this futures contract and I want to hold it, say, till December, well, the entity that's providing me, say, access to that contract, they need then to buy the underlying, they need to finance that purchase through December, right? So there is a cost of carry that's associated there. They also then would need to concern themselves with, well, how do I store, or what are the costs, say, for storing this Bitcoin? You know, what are the risks that I face, say, in terms of potentially losing that Bitcoin? So all that, say, is factored into the price, say, of the futures contract, right? Now, the futures contract, of course, settles on the last Friday of the month, settles to the price of the underlying index. Now, when we think, say, of, so how does somebody who's buying Bitcoin at Bitso, how do they know, say, what the price of that currency should be? I think that really just comes down to, you know, supply and demand and interest, right? You know, when we think of these currencies, really, it's the value that market participants are associating, say, with that particular coin. You know, when you look at something like Bitcoin, you know, we didn't talk about this earlier, but Bitcoin, the way that it's designed, it's a finite commodity, meaning that at any one point, there's going to be, or at some finite point, currently by 2140, there's only going to be 21 million Bitcoin available. Already, since the launch of Bitcoin in 2009, there's more than 19 million Bitcoin in circulation. Some of that has been permanently lost, because if you lose those keys, it's lost forever. But there is a scarcity value associated with Bitcoin, and that also helps, say, to drive value up on that particular cryptocurrency. But yeah, but at the end of the day, you know, the value of these, it really comes down to what are the use cases, what value are market participants putting on those use cases, and that helps, say, to establish, say, the price of, say, of one individual coin. Any other questions?
I have another question.
Sure.
For example, as we know, there are thousands of cryptocurrencies. Actually, there are some of them that are called shitcoins because there is not clear value in there. But going forward to the future, maybe 10 years from now, what percentage of these top 10 cryptocurrencies by capitalization might survive and not share the fate of the failure of Luna?
Yeah, that's a great question. I think, you know, when we look at the market, when we first launched Bitcoin futures back in December of 2017, and if we look, say, at the top 10 coins and tokens then, it would certainly be a lot different than what we're seeing now, right? You know, currently Bitcoin and Ether, you know, represent north of 60% or so of maybe actually, yeah, about 60% or so of market capitalization. So they are, say, the clear winners at the moment, right? But it's unclear to say if another, say, competing blockchain, you know, I spoke a little bit earlier, say, about Ether and the merge that's coming up next month. But some of the reasons why the Ethereum organization is making those changes is really to make Ethereum and Ether more competitive to some of the newer coins, such as Solana, such as Cardano, because those coins or those blockchains are already, say, proof of stake, And already say, you know, in the case of Solana, that particular blockchain has the ability to handle, I think it's something like 60,000 transactions, say, per second. And Ether, you know, Bitcoin certainly are nowhere near that at current levels, right? So I think it becomes a function, say, of how quickly institutions start adapting some of these technologies, right? But I think it's tough to say which you know, which one will survive, but certainly Bitcoin and Ether, I think currently, you know, are showing that dominance. But to your point, I think that there's a lot of these coins that really, you know, aren't going to survive, you know, maybe this year and certainly not, you know, 5 to 10 years down the line.